Ladies and gentlemen, the last year has been super tough for Verizon stock. They are now flirting with 52-week lows below $35 per share. This price point is almost unheard of for the telecommunications giant. They now pay a dividend yield of nearly 7.5%, with a PE ratio now below 7 times earnings. So is this a good price to pay for Verizon? Well, as some of you may know, I have 100 shares of Verizon at a basis of around $37 to $38, I think, somewhere in that range. So certainly, for my own purposes, I generally think that this is a pretty good price for the stock. Now, there's a lot of comparisons and contrastings done between Verizon and AT&T. People seem to always want to, ask, ooh, AT&T or Verizon, which one's better? So when it comes to me, honestly, I think AT&T has just done blunder after blunder. Worst acquisition ever, DirecTV. That was AT&T, right? I just, that's just burning shareholder value, basically. And granted, AT&T has passed that and everything, but it doesn't really give me a lot of faith in their management versus Verizon. And both companies rather have spent a lot of money and have a lot of debt. All right, the debt loading is definitely a concern in the telecommunications space, but Verizon has spent on 5G, okay, massively, more than any of the competitors. And so, if you think that investing in the core business and in that 5G spectrum is going to be a thing that makes the difference, that's what Verizon has really focused on. Will that be the thing that gives them the competitive edge over the next 5, 10, 20 years? Well, if you think so, then it would seem to me that maybe Verizon is the wiser choice when, hypothetically, both companies might be at a discount today. Now, when I look at the financials of Verizon, growth is slow. Top line. Okay, they're not massively growing their revenue, which, this is pretty much a fully mature business, right? They're not gonna have double digit revenue growth anymore. They are past that point. All right. And this is the case probably for most telecom companies, except for maybe like brand new ones that are, maybe eating away like 0.5% market share or something. But these big boys that have like, 25, 30, 40% market share or whatever, they're not going to see that kind of crazy double digit growth. You just can't expect that. What you can hope is that maybe they'll gain a percent or two market share, here and there if they have, a better, a better network, provide better products, better services, whatever it might be. Oh, they also own TracFone. That's kind of an interesting thing. So that actually, when I was in the market for prepaid, that was what I bought, was a TracFone way back in the day. So they do get a little bit of benefit from that whenever people are looking to just kind of pay as they go and not get into like long-term arrangements with their cell phones. TracFone's one of the big players there. So Verizon also owns them. So that's a little interesting. Maybe during tougher economic times, they might make more money in TracFone if they, which might counter some of the losses. I mean, they're one of the more expensive providers too, but that's because they have that reputation of having a really good network, etc. Now, when it comes to their, free cash flow and EPS, they have there are ups and downs and a bit of a disconnect between the two. Free cash flow, I think, is quite a lot lower in the most recent year because of a higher capex than usual. We can go to the cash flow statement and we can investigate that a little further. So, yeah. So the operating cash flow down slightly over the prior year, plus capex up substantially over their what looks to be their typical amount, which is in the 17-ish billion range normally, is $6 billion higher in 2022 at 23 billion. Possibly some of that 5G spending, maybe in that instance. So with higher than usual capex, free cash flow is going to be down. You see, it's a similar thing to what you see with other companies with higher than normal capex right now, like Intel. So I wouldn't necessarily judge them currently based on their most recent year of free cash flow. I would probably go more off the EPS number since that's been a little bit more consistent for the last 3 or 4 years. And that's where I would start my valuation model. So when you just pull them up, the default growth rate is set at 16.8%. Now, there is almost no way that Verizon is going to grow their EPS at 16.8% a year for the next 10 years, even if 5G goes really well and everything like that. So for the next 3 or 4 years, I saw analyst expectations more in line with something like low to mid single digits for EPS growth. Okay, so I would drop this to a 4 and maybe even further out drop it to a 3. Say, hey, maybe more in line with something like inflation in the really long run. Okay, now granted, there is always the chance they can do better, and but you have to also keep in mind there's always the chance they could do worse. Now, when it comes to the argument of whether or not to deduct their tangible book value, I'm personally more looking at their ability to return capital directly to shareholders through dividends. That's what I think the primary value is of them. Similar to Altria Group, who also has a slightly negative tangible book value. I think it's more of along the lines of, are they consistently returning a growing amount of actual money in the form of payments to shareholders? That's where I think the primary value lies. So I'm not really one to just straight out, flat out deduct them for their debt loading, even though it is a concern. I address it in a slightly different way. So, if you did just keep the standard 10% discount rate and deduct that, you would see them as being around fairly valued today. And this is probably, honestly, how the overall market is arriving at this current share price for them, which is only it's like a couple bucks different from my personal cost basis. So that's understandable and rational and makes perfect sense. Now, the way I skinned the cat is a little bit different, but it gets you to a result that's pretty close to the same amount. So I personally said, hey, I don't feel like straight up deducting the tangible book value is the best way to go. Just because I view them more as a stream of payments to me, basically. Are they paying a consistent and growing amount of money to shareholders each year? And so far that seems to be the case, although the growth is a little bit less than I'd like it to be. I simply factored in debt risk with a higher discount rate, okay? So I applied a 15% discount rate because I said, hey, I think this is ultimately more of a value based on, what the stream of, cash they can pay me. But in order to accept the risk of this debt, because the debt is the biggest risk, I think, with Verizon's business, all right, apply a much higher discount rate, and that got me to a fair value in the low 40s. So that's why when the price dropped, a good bit below 40, into the mid to high 30s the first time, it was around 38, 39 bucks. Last year, I thought, hey, write some puts in the, 37.50, 37-ish range. And, we took assignment on 100 shares. And, that's why I have a cost basis between $37 and $38. But, honestly, this is sort of, splitting hairs and kind of down to the individual preference of the investor. It's really like, do you prefer just to have a straight 10% discount rate and deduct the tangible book value? I mean, hey, maybe you're more conservative than me, right? Maybe, hey, you want to deduct that tangible book value and you want a higher discount rate. You want 12.5%. Well, if that is your, your standard, right, for your needs as an investor, you want just the deepest value you can possibly get. I mean, that would put you in the $25 range on this, right? So it's really all about your inputs and your preferences and your objectives as an investor. Now, their yield would be probably over, they would probably be breaking double-digit yields at this price point. And, because they pay so consistently, and they have been, pretty consistently, if slowly, granted, increasing their dividend. I just don't think that something with the perceived stability as Verizon is likely to get this low. And so if I realistically want, telecoms to be, a slice of my portfolio, I want it cheap, but, this cheap I don't think is really likely ever to happen. But hey, I've been wrong before. It's possible that it could crash this low. It's really difficult to, predict the future. I just think that with my assumptions, below 40 is a pretty good deal, and below 35 is, sort of almost a steal of a deal. Now, if 5G plays out for them, we could see better than expected, earnings growth, right? But you could also see worse, which is why I generally do go with a higher discount rate, etc. And by the way, if you don't deduct their tangible book and you just leave a 12.5% discount rate, you get $49 per share fair value, which actually, if you look at the way the market's been for the last few years, that's really about where it seems like the market was valuing it before. But, hey, interest rates are higher now, so people are more worried about the debt, etc. I see that the debt, a lot of it matures way, way far in the future. Some of it doesn't mature until like the 2050s. So I figure, hey, that gives them a lot of time ahead of them to, figure that out and deleverage. So personally, I think it's a pretty good bargain where it's at right now. If you have any Verizon stock, let me know in the comments below. If you like AT&T better and you think Verizon's for chumps, let me know down below. Hop on Discord, a link will be in the description. Like the video if you like it, and please subscribe to the channel for more discussions going forward. Take it easy, everyone, and have a fantastic, safe holiday weekend.